Something fundamental has shifted in the architecture of global commerce. This isn't about another trade dispute or temporary market correction. What we're witnessing is the systematic transformation of money itself into a weapon, and the battlefield spans from Shanghai's financial district to the vaults of Brussels. For decades, we operated under a comfortable illusion that capital would flow freely across borders, that supply chains existed outside politics, that the global economy ran on rules everyone agreed to follow. That world is evaporating before our eyes. Let's start where the pressure is most acute, in the industrial heartland of China, where elements you've never heard of are becoming more valuable than oil. In the port city of Ningbo, warehouses are filling with products that can't leave. Not because of quality issues or paperwork delays, but because Beijing has decided these materials are too strategically important to export freely. We're talking about rare earth magnets, compact devices made from elements like neodymium, dysprosium, and terbium. They don't look particularly impressive gray metallic blocks you could hold in your palm. But these unassuming objects power everything from the electric motors in your car to the guidance systems in military missiles. And China has an almost total monopoly on their production. The numbers tell a stark story. In September of this year, Chinese rare earth exports collapsed by 31% compared to August, the third consecutive monthly decline and the steepest drop recorded since February. This wasn't a market fluctuation. This was policy in action. Since April, when Beijing tightened export licensing requirements, companies trying to ship these materials abroad have faced bureaucratic mazes that can stretch for weeks. The result is exactly what you'd expect. Shipments have slowed to a trickle, and Western manufacturers are starting to panic. Consider the scale of dependence here. Between 90 and 98% of the world's rare earth magnets come from Chinese factories. More than 85% of the refining capacity, the specialized industrial process that turns raw minerals into usable materials, is also concentrated in China. Analysis from firms like AlixPartners and Goldman Sachs confirms what industry insiders already knew. There is no quick alternative. Over the first 9 months of this year, total rare earth magnet exports from China fell to just under 40,000 tons, a 7.5% decline from the same period last year. The biggest customers: Germany, South Korea, Vietnam, the United States, and Mexico. All of them scrambling to figure out what happens if the tap gets turned off completely. The concentration is even more extreme than the headline numbers suggest. Industry surveys show that more than 90% of magnet manufacturing occurs in just 2 Chinese provinces, Inner Mongolia and Jiangsu. These aren't diversified global supply chains with backup options. These are single points of failure, and Beijing knows it. This rare earth leverage connects directly to the broader deterioration in U.S.-China trade. Chinese exports to America have been in free fall, down 34.5% in May compared to the previous year, and down 27% in September. Manufacturing surveys paint an even grimmer picture, showing new orders from the United States shrinking at the fastest rate since 2023. But here's what makes this different from previous trade spats. Beijing seems perfectly willing to accept these losses. Chinese policymakers have made a calculated decision that protecting domestic industrial control matters more than maintaining market share in America. They're choosing strategic autonomy over short-term profits, and they're not stopping at raw materials. China has also consolidated dominance in global shipbuilding, now commanding roughly 73% of worldwide orders by tonnage. That's not just an industrial achievement, it's geopolitical leverage. When you control the ships, you control the routes. When you control the routes, you control global commerce. This isn't the China of 2 decades ago, assembling products designed elsewhere. This is a China that has climbed the value chain, secured choke points across multiple industries, and is now prepared to use those advantages as instruments of state power. The question Western policymakers are confronting is uncomfortable. What do you do when your adversary also happens to be your factory? Washington's response arrived not through diplomacy, but through the ports themselves. On October 14th, something unprecedented happened. The United States and China began imposing reciprocal port fees specifically targeting each other's vessels. These weren't standard docking charges. These were politically motivated tariffs dressed up as administrative costs, a new front in an economic conflict that keeps finding novel battlegrounds. According to industry executives, the U.S. Trade Representative floated fees as high as $1.5 million per port call for ships built in Chinese yards. Think about that for a moment. $1.5 million just for the privilege of unloading cargo at an American dock, purely because of where the vessel was constructed. Beijing's retaliation was swift and symbolic. Chinese authorities blacklisted 5 U.S.-linked subsidiaries of Hana Ocean, a major South Korean shipping company. The company's stock dropped nearly 6% in a single trading session. The message was unmistakable. If Washington wants to play regulatory hardball, Beijing can match it move for move. This maritime standoff reflects a deeper structural shift. In the year 2000, China accounted for just 5% of global shipbuilding. By 2023, that figure had exploded past 50%. The United States, meanwhile, has atrophied to less than 1% of global production. What this means in practical terms is that any American attempt at reindustrialization, any effort to rebuild manufacturing capacity at scale, requires importing not just capital, but expertise. And much of that expertise now resides in the country Washington considers its primary strategic competitor. Beijing can exploit this dependency simply by slowing approval processes for foreign investment or delaying permits for technology transfer. No dramatic announcements necessary, just bureaucratic friction applied at precisely the right pressure points. The spillover effects are already visible in unexpected sectors. Take agriculture. In September, China imported exactly 0 soybeans from the United States, the first time that's happened in 7 years. Grain, magnets, ships, semiconductors, each sector reinforces the same pattern of deliberate economic separation. Industry analysts estimate that redesigning electric motors to reduce dependence on Chinese rare earth elements will require not just years of engineering work, but billions of dollars in investment. Even then, the alternatives won't perform as well. For the foreseeable future, Western manufacturers remain locked into Chinese supply chains, whether they like it or not. And then there's the question no one wants to answer publicly. What happens when the cost of every diverted vessel, every delayed export license, every $1 million port fee gets passed directly to consumers? Because that's exactly where these costs are headed. Into the prices ordinary people pay for everything from groceries to electronics. Port executives have said as much in off-the-record conversations with journalists. Every new regulatory barrier feeds straight into inflation. Every geopolitical maneuver shows up eventually on someone's credit card statement. We're watching economics and national security merge into something indistinguishable. And the consequences are about to hit home in ways most people haven't begun to imagine. While ships stall and magnets sit in warehouses, another signal is flashing in the financial markets, one that reveals just how deeply trust in the global system has eroded. Gold prices rocketed above $4,200 per ounce by mid-October, reaching levels that would have seemed fantastical just a few years ago. Then, in a single trading day, the price collapsed by 5%, the sharpest one-day drop since 2020. Financial analysts pointed to the usual suspects: Federal Reserve interest rate speculation, safe haven demand, inflation hedging. But the real story lies deeper, in a structural transformation that's been underway since 2022. Central banks around the world have been buying gold at a furious pace, over 1,000 tons annually, and critically, they're storing much of it outside Western vaults. Why? Because they watched what happened to Russia's reserves and drew the obvious conclusion. If you hold your wealth in dollars or euros, it can be frozen with the stroke of a pen whenever geopolitics demands it. This is the financial equivalent of keeping cash under your mattress because you don't trust the bank anymore. Except in this case, the mattress is a vault in Shanghai or Dubai, and the bank is the dollar-denominated international financial system that has underpinned global trade since Bretton Woods. When central bankers, people whose entire professional lives revolve around managing monetary stability, start hedging against the very reserve currencies they're supposed to trust, that's not market volatility. That's a crisis of confidence in the system itself. And nowhere is that crisis more acute than in Europe, where policymakers are contemplating a move that would have been unthinkable a decade ago. Roughly $300 billion in Russian sovereign assets sit immobilized in financial institutions worldwide. About $210 billion of that, nearly two-thirds of the total, is frozen in Europe. The single largest chunk, €185 billion, sits in the accounts of Euroclear, a Belgium-based financial services company that specializes in settling securities transactions. These aren't oligarch yachts or penthouse apartments. This is the Russian state's money, reserves built up over years of oil and gas exports, held in what were supposed to be safe, neutral financial institutions governed by international law. European leaders are now debating whether to use that money to fund Ukraine's defense, not the interest it generates, the principle itself. Some proposals involve leveraging the frozen assets as collateral for a massive loan, potentially as large as €140 billion, with the proceeds earmarked for weapons production and reconstruction. The European Commission insists they're only talking about using the profits generated by these accounts, not seizing the underlying funds. But legal experts warn the distinction is blurrier than politicians want to admit. Once you start treating sovereign reserves as a piggy bank for proxy war financing, you've crossed a line that can't be uncrossed. Moscow has been crystal clear about how it views such a move: theft, plain and simple. Russian officials have warned that liquidating these assets would undermine trust in the euro area banking system and erode fundamental property rights that underpin the entire global financial order. And they're not entirely wrong. Think about what this precedent establishes. If European institutions can decide that Russian reserves are now available to finance Ukraine because of geopolitical disagreements, what stops China from making similar calculations about Western assets on Chinese soil? What prevents any nation with a grievance from declaring that foreign-held reserves are now negotiable based on political considerations? The framework being discussed includes a 12-point conditional plan. Sanctions would be eased gradually, reserves released incrementally, but only if Russia agrees to pay into Ukraine's reconstruction fund. For the Kremlin, this is an existential bargaining chip they're being asked to surrender. Meanwhile, Russia's economy grinds forward under strain. The International Monetary Fund projects growth at just 0.6% for this year. The central bank has jacked interest rates to 17%, trying to control inflation. Oil sales have shifted eastward, away from European customers and toward Asian buyers willing to work around sanctions. Here's the uncomfortable truth. Punishment and endurance coexist. You can sanction a country severely and still not break it, especially if that country has commodities the world needs and alternate customers willing to pay. Internal European debates reveal additional complexity. Several EU capitals want any loan backed by Russian assets to mandate that proceeds be spent on European-manufactured weapons. Kiev, understandably, wants flexibility to spend funds where they're most needed. If this loan goes through, it would mark the first time a Western bloc has financed a war using the seized wealth of its adversary, precedent disguised as emergency policy. Italy's Prime Minister Giorgia Meloni has emphasized that any use of Russian assets must respect international law, even as pressure builds to tap into those funds. The tension between legal principles and geopolitical necessity has never been sharper. What we're watching unfold is the weaponization of the financial system itself. For 70 years, the implicit bargain was that you could hold reserves in Western currencies and institutions without fear of politically motivated seizure. That guarantee is now explicitly conditional, and every finance minister on Earth is taking notes. These geopolitical chess moves aren't happening in a vacuum. They're occurring against a fiscal backdrop that makes traditional policy responses increasingly difficult. The United States Congressional Budget Office estimated the federal deficit for fiscal year 2025 at $1.8 trillion, roughly 6% of GDP. Interest payments on the national debt have surpassed $1 trillion annually for the first time in American history. Tariff revenues narrowed that deficit slightly to $1.775 trillion, but that still ranks among the worst fiscal years outside of declared wartime. When you're running deficits this large and interest rates remain elevated, policymakers lose access to traditional monetary tools. You can't easily cut rates when inflation remains sticky. You can't engage in massive fiscal stimulus when debt service costs are already spiraling. So you reach for other levers: tariffs, port fees, investment restrictions, sanctions, and you rebrand them as national security measures. China faces its own economic headwinds. Third-quarter GDP growth came in at 4.8% year-over-year, down from 5.2% in the second quarter. Fixed asset investment, a key indicator of long-term economic confidence, fell half a percentage point compared to the previous year. Beijing is juggling the need for domestic stimulus while simultaneously using trade and investment policy as external pressure tools. Federal Reserve Governor Stephen Moran warned in October that renewed U.S.-China trade tensions pose material risks to American growth prospects. What starts as regional supply chain disruption doesn't stay regional. It ripples outward into macroeconomic policy debates and consumer price indexes. On the investment front, Chinese firms trying to enter the U.S. market face scrutiny so intense it's effectively a blockade. Technology transfer concerns, dual-use equipment restrictions, telecommunications infrastructure red flags, the barriers are numerous and deliberately opaque. Meanwhile, Beijing pushes Washington to relax tariffs and remove investment restrictions, creating a standoff where capital flows, once the engine of globalization, have become strategic weapons. Automotive and metals industry sources describe a race against time. With China controlling approximately 70% of rare earth mining, 85% of refining capacity, and 90% of magnet production, Western manufacturers face a nightmarish scenario. If export controls tighten further, European and American factories could face shutdowns within months, not years. The chip sector illustrates how these industrial and security concerns interweave. In late October, negotiations between Dutch and Chinese economic ministers failed to resolve a standoff over Nexperia BV, a Dutch-based chip maker that China has blocked from exporting to Europe. German automakers warned of production shortages unless licensing approvals accelerate. The boundary between industrial policy and national security has dissolved completely. Diplomatic channels, meanwhile, have become venues for public grievances rather than private negotiations. On October 16, China's Commerce Minister Wang Wentao publicly stated that intensive U.S. restrictive measures, announced after a meeting in Madrid, had undermined bilateral trade talks and harmed China's interests. The language matters. Beijing is framing investment curbs and export restrictions not as economic policy, but as diplomatic provocations deserving retaliation. Ukraine, caught in the middle of Europe's frozen asset debate, resists conditionality being attached to any loan. Kyiv wants autonomy over how funds are spent, rather than being forced to purchase exclusively European-manufactured weapons. This tension reveals that even within alliances, financial engineering has become contested terrain. Russia, for its part, continues to warn that any move it considers confiscation of sovereign funds will undermine trust in the euro area banking system and erode property rights globally. The threat isn't idle posturing, it's a calculated attempt to make Western policymakers consider second-order consequences. If the sanctity of sovereign reserves becomes negotiable, what other international norms are up for grabs? A detailed analysis published in October broke down the global tally. Approximately $300 billion in Russian assets remain frozen worldwide. $210 billion of that sits in Europe, with $185 billion specifically in Euroclear accounts. If Brussels proceeds with securitizing those funds, if Beijing continues metering magnet exports while fortifying maritime control, the next major geopolitical signal might not come from a central bank press release at all. It might come from an invoice. A single ship, rerouted at the last minute, charged $1 million simply for crossing an ocean that used to be considered neutral territory. That's where we are. That's how far the system has fragmented. Let's zoom out and see the full picture. We're witnessing the deliberate dismantling of the post-World War II economic order. The system of open markets, neutral institutions, and predictable rules that enabled unprecedented global prosperity. That system depended on a shared understanding that commerce existed somewhat apart from politics, that property rights would be respected regardless of diplomatic tensions, that supply chains could stretch across ideological divides. Every assumption is now being tested. When China restricts exports of materials that power electric vehicles and defense systems, that's not trade policy, it's leverage. When Europe debates liquidating Russian reserves to fund a proxy war, that's not sanctions enforcement, it's asset seizure dressed in legal language. When Washington imposes million-dollar port fees based solely on where a ship was built, that's not maritime regulation, it's economic warfare. Each action individually might seem defensible, even necessary given the geopolitical tensions we face. But collectively, they're constructing something entirely new. A world where every economic transaction carries political weight, where supply chains are loyalty tests, where holding foreign reserves is a calculated risk rather than a given. The old bargain was simple. You could do business anywhere, hold assets anywhere, ship goods anywhere, as long as you followed basic rules. That bargain is dead. What's replacing it is a fragmented system of rival blocks, each controlling critical nodes in global production networks, each willing to use that control as a weapon. The consequences will be profound. Consumers will pay more for everything as redundant supply chains get built and shipping costs multiply. Innovation will slow as researchers lose access to materials and markets. Smaller nations will be forced to choose sides in disputes that don't concern them, because remaining neutral will mean losing access to goods and services controlled by one bloc or another. Most troubling is what this does to trust. International finance depends on the belief that certain institutions and instruments exist above day-to-day politics, that a dollar is a dollar, that sovereign reserves are sacrosanct, that contracts will be honored regardless of who's currently feuding with whom. Once that trust evaporates, once every nation starts treating the financial system as just another arena for geopolitical combat, the costs of doing business across borders will skyrocket. We'll still have global trade, but it will look more like the mercantilist arrangements of the 18th century than the integrated markets of the early 21st. Perhaps most ironic is that all sides claim to be acting defensively. Beijing says it's protecting strategic industries from Western interference. Washington says it's safeguarding national security from Chinese industrial espionage. Brussels says it's defending international law by punishing aggression. Everyone's defending. No one's attacking. And somehow we've still managed to construct a system where the world's three largest economic blocs are actively working to reduce their interdependence, regardless of the cost. The ships will keep sailing, the magnets will keep moving, the gold will keep trading, but the invisible infrastructure of trust and predictability that made the modern global economy possible, that's crumbling in real time. We're not just reorganizing supply chains or adjusting tariff rates. We're answering a fundamental question that will define the next generation. Can an interconnected global economy survive in a world of renewed great power competition? Based on everything we're seeing, the frozen reserves, the export restrictions, the million-dollar port fees, the answer increasingly looks like no. We're building a new world order. The question is whether anyone will be better off once it's finished. If this analysis helped you understand the reshaping of global economics, consider subscribing for more in-depth coverage of the forces transforming our world. The next video explores how technology is becoming the ultimate battlefield in this new Cold War, and why the chips in your phone are now more valuable than oil ever was.